I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome back, Wyckoff Nation, to the Wyckoff Market discussion. Today is April 10th. This is session number 15 of year 2024, episode 398. Yeah, we're close to episode number 400. This means for almost 8 years in a row, Bruce and I would get together on Wednesday with you and go through the market and give you our analysis. So we're going to celebrate the 400th episode pretty soon, pretty exciting. In the schedule, in our curriculum for this semester, in the upcoming semester, summer semester is going to start with the WTC1. Alessio is going to teach that foundational flagship class. I'm going to be teaching the practical Wyckoff Trading course part 2, where we practice a lot. Then, as usual, on Tuesday, together with William, we're going to do the tape reading lab. For those of you who would like to extend your knowledge on how to read the chart, that would be the class. Together here with Bruce, as usual, and going on the 400th episode for Wyckoff Market discussion each Wednesday live here. Crypto discussion as an on-demand video from Alessio each Wednesday. Check out the Crypto Discord, or check out on Fridays the Wyckoff Market Report release from Alessio on stocks and the stock market. Absolutely a worthwhile read going into the weekend. Or just go to stockcharts.com and read Bruce's blogs. Or the current blog, and he's very, very timely on a lot of the things that he publishes in his blogs. And again, I'm just going to repeat, Bruce's blogs could be read as a book, and there's just plenty of amazing information on the methodology itself, and also a lot of case studies. Over the weekend, go and update your watch list with our communal Wyckoff watch list, or do our Wyckoff bias game. In the special schedule, we're going to start in May, on May 2nd, with the intraday trading. We're going to have 2 sessions on May 2nd and May 9th, 3 hours each. This is just kind of like how I like it. And we're going to go through a lot of topics. So here's the curriculum. Go register. Because this is a part 2, you will have to be the attendee of part 1. Because there is a progression of thought, there is a progression of knowledge. So I want you to kind of like follow that. Really quickly, what are we going to be talking about? Pre-market analysis, structural analysis before the open, then the opening sequence. How do we go with the first bar? What does it mean in the context of the pre-market? How do we go through the first 3 bars? Let's say like on 3 minutes, the first 15 minutes, 30 minutes, 16 minutes, and then the intraday structure after the opening sequence. What does it mean that the intraday trend is sustainable? Global versus local structures and their characters, trading range identifications, and some other things about the structure. VWAP as another way of looking at the structure, and we'll look at the VWAP and standard deviations for the targets and boundaries, stop losses, and so on and so forth. Then we're going to go into the character read with the VSA, volume spread analysis and swing analysis. I'm going to give you a lot of interesting case studies that again, I comment from our highly successful intraday and swing programs that we are training programs that we are running right now. Those are pretty intense, so there is a lot of information coming out of that. You could just read this. Then I've introduced to our trainees the ranking of the bars and the ranking of the swings and the tests. For those of you who took the WTC1 course before, we kind of had it, but this is way, way more sophisticated. So absolutely a must kind of like to have a look and maybe to immediately apply it to your chart reading if you're on that time frame, or even if you're on the daily. Then we'll talk about the tactics. Where do we reverse the position? Where do we add? Where do we trim? trading range tactics also is extremely important. And then I'm going to introduce to you an idea of the playbook. This is not a trading plan. This is something else. So I'm going to give you examples of those. And then we're going to dive into the beautiful world of analogs, and I'm going to classify some of the intraday structures for you. We're going to go through the most obvious things, but then, we're also going to go into the details of the sub-classifications. And I'll talk a lot about the mindset, because at the end of the day, this is what matters the most at that highest Olympic level when we intraday trade or swing trade at that level. So if you want to attend, go register for this part 1. And then also I want to promote the special that comes in June. This is the option special that our team member Eric Causeway is going to conduct. This is 3 sessions, 2 hours each, and we for a long time wanted to have a combination of the knowledge on options and Wyckoff methodology. And finally, we have it. So I'm extremely excited. I'm going to be a student in that class. And Eric is going to take it from the beginning level to intermediate level. And this is where that special is going to be. I am anticipating maybe part 2, part 3 coming out with more sophisticated strategies. But in session number 3, we're definitely going to talk about how could we use our understanding of our Wyckoff structure with understanding of how we could, what strategies, option strategies we could apply. And that's about it. Bruce, how are you doing today?
I'm terrific. It's just great to be here. And thank you. Welcome to our guests. And thanks for joining us for probably a pretty important session because of the way the market acted today. And this I think was a very important day. So hopefully that comes out in our talk.
Before we go to the markets, really quick announcements. For those of you who's going to sign up and become the new members of the WMD, welcome to the family, welcome to our community. You have 1 week to register to get the promotional rate of $79 per month. For those of you who are members of WMD and you were on an older rate of $99, no worries. Nancy already converted you, so you don't have to do anything. Just, enjoy the show. Bruce, all right, let's go to the first slide.
Well, really, this is just about the blog that I publish at stockcharts.com. And the most recent one is April 5th. And I am going to be increasing my publication rate, posting rate of blogs. And so I'm very excited about that because I really, really enjoy the blogs a lot. And I get a lot of good feedback from our people about that. And so I'm very grateful for your readership. And just really this most recent one, Trifecta of Trouble, is a little bit about what we're going to get into today, in part, including a number of other things, because we want to really set the stage. This is going to be a bit of a review for our community, for our people today, but I hope that we do it in such a way that we really sort of develop a holistic big picture for what things look like going forward here in the next quarter, through the rest of the year, and then into the future, into next year. And so this is going to be, I think, really a very valuable review, also in consideration of what has transpired today and how it fits into the bigger picture of the trifecta of trouble, among other things that we've talked about in recent episodes. So Ramon, your thoughts?
Well, I thought that was such a timely blog, right? Because we've talked about that upcoming change of character. We've identified the timing of where demand has contracted. We saw supplies coming in, so that was just perfect. And again, just want to reiterate, please go to Stock Charts, find Bruce's blog. And if you're into Wyckoff methodology, you have to read. It's a must read. There are certain things that you have to read as a student of the methodology. Bruce's blog is one of them.
So here we're looking at a chart that is actually in that particular post, and this is the S&P 500. This is a daily chart. You're going to look at it and you're going to go, oh my God, it's like such a mess. But in fact, this has been kind of our document, our record keeping for our thinking about how this market has unfolded. Because in real time, what we've done is we've established using these key junctures or characteristics, and we've labeled them as we went. And I've taken the chart back to the 2021 bull market peak. And these were attributes of the market that we were talking about in real time. And we put up the symbols for what we thought was happening and how it was unfolding in the distribution structure. And then subsequently the accumulation that occurred underneath that in 22 and 23. And so you can see here that was a tremendous downward stride in the market that climaxed in a number of different steps in May, June, October of 22, and then into 23, it started to have on a rising scale the completion of its accumulation structure. And we'll talk a little bit more about this, but this is the beauty of what Wyckoff does for us, because the Wyckoff is a methodology, and I really want to make that point because Ramon's going to do this magnificent intraday workshop. And basically what stands out in this workshop is that it's all about the method and how you as a trader, market operator in the intraday time frame, whether you trade every day or not, is able to use the tape, use the unfolding nature of the market to make your decisions. This is what Wyckoff taught us. And in this particular case, you can see here this accumulation structure, and this was all taking place as we had a negative yield curve, as we had very high and rising interest rates, tremendous levels of fear. But what makes an accumulation structure is pessimism. And pessimism causes institutions, causes individuals, causes foundations, causes government entities even to raise cash, be defensive. That is the fuel that's going to drive future higher prices. And so here we see in this accumulation structure, the way we should read that is that the CO is systematically, the composite operator, accumulating shares at value prices while the public and all these other lesser institutions are becoming defensive, raising cash, etc. And they are the ones that later on are going to drive prices higher as they come back into the market. And this cycle occurs over and over and over again. And here we see that very thing happening, and we documented it in real time. We actually were trading here at WMD these different junctures. You can see the swing trading junctures where, for instance, in the selling climax back in June of 22, you can see a swing trading accumulation area. And if you look down here at the bottom in this oscillator, you can see the stocks above the 50-day moving average. Look at the positive divergences. Underneath the surface internally, you can see the smart money building positions in stocks inside of the weakness and the fear that's developed in the market. Look at how it threw under this channel. This also occurred at this secondary test spring area. That's a beautiful swing trading structure. We did the point figure work on that. you can see I actually notated where the point and figure chart went to and so on. And I don't want to belabor this, but also you can see as the markets become overbought, looking at the stocks above the 50-day, we do two things with these oscillators. We look for oversold and overbought conditions, and we look for divergences, which sometimes we get, sometimes we don't, and then we look for directionality. And so the directionality is either up or it's down. You can see that the market prices coincide with that. These represent opportunities for us to trade. And Ramon, I'll stop right there. I have a few more things to say about this chart, but I know you have a lot of comments.
Well, first of all, let's just ask ourselves a question. What now? What's going to happen now, right? So we overcame the all-time high of 22, and the nature of the advance to that all-time high and the extension above it still suggest that the cyclical uptrend is going to continue. Even if we're going to have some kind of reaction, and this is pretty healthy because we are in the uptrend here. Look at this trend, trend channel. And this extension here is suggesting that there is buying at the new price level. Institutions are still buyers on the way up, and then demand starts to deteriorate and starts bringing us, some kind of change of behavior into the most recent reaction. But so far, the character on the way up with the extension is suggestive that the the bull market has to continue at some point, unless the change of behavior will be too dramatic here, and the character would change dramatically. We could analog it to this reaction right here, and we could say that there were multiple legs to the downside. So, for instance, 1, 2, 3, 4, 5. So we're seeing how the first leg took out the last advance. We could anticipate maybe something akin to what we've seen back then, maybe into NVIDIA bar right here, where the price just falls into the base here, or even slightly lower right here. And we're still, relative to the all-time high, should be able to hold here. So, Bruce, I'm thinking going forward, our goal is to identify the character of this, ongoing reaction behind this divergence that we're seeing in price and in the breadth. And as it goes down, try to find the opportunities that are outperforming market. As we have the reaction, go into our watch list, identify the stocks in the rotation that is favorable for the bullish continuation, and then find the timing for the market reversal. And we've been discussing a lot of scenarios with Bruce in this class as to how this correction might look like relative to, let's say, quarters, relative to the US election that is coming, relative to the news from Fed. And today was obviously, such a big day on that. And these are my initial thoughts, Bruce, here.
So the trifecta of trouble, that was great, Ramon. The trifecta of trouble is really, there's three things at work here that happened at the throw over of the upward stride of the channel. And that is, number one, we had an overbought condition and a throw over above the channel line. And so you can see that we've done that. That's a sign of exhaustion. It came with some other essential conditions. One is, we have a great way to be able to estimate the potential price move of a stock, of an index, using the very old school Wyckoff method of horizontal point and figure counting. And we're going to show you some point figures in a minute. And so we have fulfilled a point and figure count, but there are higher counts ahead. The thing is that we can't estimate when we're going to hit those counts. We can estimate how far the move should go or has potential to go. But we did hit a very important point figure count level in both the S&P and the NDX at the peaks that it went to, and as it threw over into an overbought exhaustion. Now, the thing that we look for, and then the third thing, the third of the trifecta is extreme bullish sentiment. And we have that too, and we'll show you some examples of that. But now what we look for is, as Ramon just said, a break back into the channel. And look what happened today. On this very day, we went down and we touched the channel line and slightly went through it, and then it basically held it. I think that was part of what happened today, was that it had that deep oversold condition and then just went into a very tight range, which I believe the channel line played a role in holding the market up today, Ramon.
Mm-hmm. Yeah, and you know, we could be even not in the correction per se that is more vertical like we've had before. What defines the verticality, or let's say the horizontal structure of the correction? Usually the earlier corrections are going to be more supply populated, where off the bottom institutions are buying, and then they are more willing to depart to their position or sell some, take profits because it's early on in the trend. But once the trend is more established and it shows its bullish character, then we might potentially even have just, you know, the first leg down and then just correction like this. Think about 2016, what has happened before Brexit. Think about the 2016 election before Trump was elected in November of 2016. Also some kind of trading range, then going and undercutting the support as a sprint and aggressively recovering from that into the end of the year. So Bruce, we're going to talk about the seasonality, and I think this type of patterns are going to come out, you know, in our discussion.
I couldn't agree more. And then the other thing that I think really is at work, and you've already mentioned it, Ramon, is the way that the market corrects. Keep in mind that in a reaccumulation structure, that often, especially the way Ramon just drew it there, you have a very sharp reaction in the initial stage, because an uptrend, you can't see it. You can see it in the way price acts in the uptrend, that the way it gets choppier and more volatile as it goes up. You have weaker and weaker holders, weaker and weaker traders and speculators that are coming in and trading the uptrend. They're momentum type traders, and they're trading it on the way up, much more skittish. And they, when the market does break, they will run away very quickly, and it creates a tremendous volatility to the downside. As it comes back into the channel, that very well could happen. And so the very first reaction in a reaccumulation structure tends to be the most violent. And it is scary, but then it stabilizes, and then each up and down move in the reaccumulation tends to have diminished volatility. And that's a very important tell to us that it is unfolding reaccumulation. And this is what Ramon was alluding to. I think that, Ramon, we could very well have a correction of sorts down into the support zone, which is above the bull market high of 2021. And that that could very well represent, and notice how the channel, the way it's going up, that they very well could meet out here in the future. The bottom of the channel as a reaccumulation unfolds throughout the course of the mid part of the year. And so I totally see that happening. And I think this sets up a glorious opportunity, because there is the potential for higher prices, as we'll show you in a minute.
Okay, let's look at the causality and the potential. And I consider Bruce to be, you know, #1 in the world on the horizontal PNF counts, you know, based on the Wyckoff methodology. So Bruce, what do we see as the cause and the projected effect of that cause from the accumulation structure that we have seen unfolding since May of 2022?
Yeah, so this the reason we use this particular chart is because we published this, talked about it here in WMD in January of 2023. And what makes this point and figure chart so important is that we were estimating that this was the LPS type action, or the final higher low test of the accumulation area, and that the uptrend was already just starting with that first initial higher low right there where Ramon drew LPS. And we took a 3-segment count across there, and this 3-segment count gives us the potential for how far prices can go up. And you can see that we had a swing count up to this 45.75 area, which came into play and also was an important resistance area. But the more important count, notice the number 21 columns across. This is a 25-point scale S&P point and figure chart, 3-box reversal, and there's the entire accumulation structure. This is what I was saying about looking at this accumulation area. This is an area that when we look at the visuals of this as Wyckoffians, and you all our guests get to be Wyckoffians for a day and be part of our community here, is that we see this as a measure of the extreme pessimism that exists in the marketplace. And we can measure it in a number of different sentiment ways, but we see sentiment in the price action. Just as we saw sentiment in the price action at the top under distribution in 2021. So we see this accumulation area and we go, this is building fuel for the next bull run. And at this point, we made this count because we thought this is the completion of this accumulation area in a nascent emerging uptrend. And this is during a phase when there was tremendous pessimism out there. And a friend of ours from Golden Gate University, Joe Granville, truly one of the legends of Wall Street. And he used to come out to GGU and lecture, and we'd go to dinner, and just an incredible technician. And he coined the phrase climbing the wall of worry. And that's exactly what the markets do, is they climb whatever the essential worry is among most investors on Wall Street. It climbs against their pessimism. And that's climbing the wall of worry. And that's just what was happening. Look at the counts that we had. We had a segment, this 21 column count took us to 50.75 to 53.50. Now, that's where we just went to. We have just fulfilled that count objective with that throw over into an overbought condition on the vertical chart, which we just showed you. Then we have the bigger count, 37 columns across, which counts up to 62.75 to 65.50. Now, what kind of we find so interesting about this is that we took the count area is across the 37.75 area. So 37.75 we count across the structure right here. And that is where the count was taken from. And it was taken at the time that the S&P was at 4,000. And I saw a number of Wall Street analysts and Wall Street technician estimates in the last number of weeks that were calling for, now we were already at new highs for the bull market. They were calling for the S&P to get over 6,000, or the S&P potentially to get to 7,000. And they were just calling for that. And at the time that we did this chart, I was getting, people were sending me, you know, everybody was really kind, but I was getting all this feedback from readers and from, you know, viewers of Power Charting that were saying, you're nuts, you're crazy, this can never happen. And our mentor, Hank Pruden, used to make these big accumulation counts in prior bull market accumulation areas that were just seemed absurd at the time, and they came to fruition. And so here we are looking at this, and guess what? This count could potentially be made even bigger. And I'll show you how that could be in a minute. So anyway, Ramon, your thoughts?
Well, I think the simplistic strategy here, as you go through this 2022 market, and if you don't have the skills to identify, potential stop in action, potential bias change, potential change of behavior, then just look at the very simplistic technical analysis rules where the PNF breaks through the structure, and that is in itself a change of behavior. Just a small kind of like tip here.
Now this chart I'm more or less brought up to date. This is April 3rd, and this is that accumulation area. Now it looks a little different because the scaling is a higher level scale. It's 50 points instead of 25. And I did that. That's just a technique for being able to compact the data a little bit. And notice that it took us up to 4850 to 5250. And we went exactly to 5250. So that so far in the S&P is the high print on this chart. But note that we have this higher count still available to us, 6350 to 6700. And Ramon, what I think could happen here is that we get a reaccumulation structure that gives us a confirming count. And that confirming count, once that reaccumulation gives us a count that matches this 6350 to 6700 area, that's often a unique timing tool. Once that count is made, the market is ready to start to rise again and go up to that level. And so this reaccumulations are just, again, clearing out the weaker holders of stocks, putting those stocks in the hands of the CO types, and setting up the conditions for really strong hands, holding those stocks up to the higher objectives.
Bruce, really good comment here from Kurt. Account from the support line of 4400 could exist as well. I would say that on this chart, I clearly see the last point of support, the next last point of support,
Yes,
which is the high or low. Like we've said, it was right here, and Bruce was taking discounts right here. You want to go Hank count, and obviously we call those crazy big counts here.
yeah,
Across this line right here, and Bruce, we were preparing for the session, said like this is the line right here. This is where the selling has happened and the buying started to happen. So, Bruce, did you do this count? What did it lead us to?
you know, I don't have it exactly in my head, but let me just say this: that what I tend to do is I tend to, you know, eat the elephant. How to eat an elephant one bite at a time, and I tend to segment counts and think in terms of reaching these different junctures. And I took the count across the whole accumulation area that I consider to be conservative, and but always with the idea that the bigger count was available. And as we start to complete reaccumulation and mark up from that, if that's a big if, we can do that, then that's, I think, the time to take that bigger count. But Kurt, you're absolutely right, and I'm with you all the way on that.
Okay. Intraday picture with the intraday PNF. So this is also a variation on how we could use PNF and horizontal PNF counts to aid us in the swing trading and intraday. And Bruce, Usually the question at this spot from us to you is, what is the potential account for the unfolding reaction?
So this is just an attempt to label the distribution. We actually, 2 weeks ago, I think it was, put up this emerging distribution style structure as it was unfolding, because we could see initial thrusts in what I've labeled the buying climax and the upthrust. At those were telling us that exhaustion was developing in the uptrend. And so now, and we said as we were making these intermediate counts that they could grow bigger. And in fact, that's exactly what they did. And now with today's CPI data, we had weakness that has literally gone down to the support area. And we may get some attempt to pause here, but you can also see I do the intraday advanced decline oscillator of on the New York underneath, and you can see it rolling over and now having a downward stride. But there's the point figure count, Ramon, on the right, and that is as of today. And you can see there that there's a series of LPSYs, and then the breakdown to that 5145 area, which is a little sign of weakness. And it takes us 5010 to 4960. Now, having said that, we can't really, this is all 30-minute data on the point figure, 60-minute data on the vertical, is that that count that we're seeing could actually grow bigger, because you can see that there's preliminary supply areas over on the left in early March. Yeah. And so
yeah, go ahead.
No, go ahead.
Yeah, I just wanted to go through the intraday structure here. There is most definitely increase in selling that's still being consumed, absorbed by the demand, by some buyers, but then buying deteriorates on the way up, climactic run, and then look at this compression of all of the supply that's coming in. And out of that, so little primer on the intraday workshop, what would we be looking at? Change of behavior for the developing test, inability to overcome. Next reaction is even more aggressive, more vertically down, presence of the supply, some selling in this area right here, gap down, then a lower high and more aggressive move down as a sign of weakness, and less progress to the upside. And within the test, we're definitely seeing more bearish signs with the spread, with the increased supply, and that is suggestive of the continuation to the downside. So with that, a very classic way of how volatility comes in, how more selling comes in, and it starts to increase the downward result. And that's what we're looking for. We're looking not just for the signs of the supply presence, which is a very common mistake. Like sometimes I see a lot of students, coming out of their positions as supply is coming in. The question to ask is, as supply comes in, what is the result? And also, obviously, anything that gives us an indication of any type of divergence from a healthy behavior, from the healthy participation in combination with the price deterioration, this is something that we're looking at. So in this way, we were anticipating this, and the market was too strong to give it to us right away. But then once it happened, it kind of became extremely evident.
I would only add, Ramon, that you can see after, now I labeled that as an upthrust, but I also see that as a buying climax. And we could have a debate about it, but it's not important, is that notice that each reaction is more volatile as you go through here. And this is a really important part of, I think, today, Ramon, and I'd love to have your intraday chops on this, because we had a volatile break down to the support areas as labeled by that sign of weakness there. And if this is becoming ever more volatile, then we could have potentially an even more volatile break of that level in short order, maybe after PPI comes out, because this market appears to be building a very volatile distributional style structure.
Yeah. Usually when the trend is so strong and you're going through the distributional structure, you are going to have, like those reactions that are going to spook you a little bit, right? Because they're so aggressive. And the thought here is just to understand how much of the demand is coming in. Do we have enough demand to produce a significant rally? And then what is the result relative to the points of control? And we're seeing that despite of what looks bullish but acts bearish, there is nothing else there. Immediate negation, and we are at the support already today. So with that, still, pressure to the downside.
This particular chart is now, this is a triple Qs interchangeable with the NDX, and you can see here what I've done is kind of a unique point and figure. We do these from time to time. Alessio has really taken the percent scale point and figure method, which I think we've done much of the innovation on. And I sort of established a procedure for it. Alessio has taken it to a new level. Amazing. And here you can see the accumulation area going back into 2022 on the triple Qs. And this is a one box method, but that's 2% scaling. So what we're doing is we're doing basically log scale point figure, which is fantastic for a bull market. And so you can see here, this is really interesting because look at the upper count in this log scale structure. 449.46 is the high count on a log scale, and the highest count or the highest print that we had was 449.34. Wow, is that like a hit, a perfect precision hit or what? And now, having said that, I know some of you are asking the question, well, does that mean that the bull market is over for the triple Qs? And we have been here for a very long time, talking into last year, talking about rotation away from the mega caps into the better value character or areas of the market, which are in the S&P, in these other indexes. And so I don't know that the triple Qs aren't going to make higher prices. They very well could, but they could lose their momentum, and we'll show you a chart why we think that could happen, but also rotate more into the other value segments of the market, which includes areas that are starting to come to life, like materials and so on. And we've talked a lot about that. But this is an interesting condition and something we're going to follow very closely. But the precision in this chart is unbelievable. So anyway, and so here is the NDX on the left, and below it is the stocks above their 50-day on the NASDAQ 100, that oscillator, and then below that is the NASDAQ composite, all of the composite with the stocks above the 50-day. Both of those are very, very useful, but you can see that you've gotten to a new high above the 2021 high. The NDX is really dominated exclusively by the Magnificent Seven type stocks. And there's certainly many more than just the 7 that have been stellar performers. But now what I did is I did using 30-minute data, I did a count of the distributional area up there in the triple Qs going back into February. And you can see that count across that area counts 382.20 to 376.32. And so, And you can see the hinge. I sort of highlighted in the point figure the hinge there, and it did break down out of that hinge today. I did not update the chart for today because the counts didn't change. And so, but we did break down out of that hinge structure, Roman.
Mm-hmm. This is a pretty interesting look. Bruce, where did you get this information and what does it show us?
As I understand it, this chart came from Piper Sandler, and it's a magnificent chart and very interesting. Just got it, and we wanted to share it with you. And I will confirm where it came from. I apologize, didn't put the source, but I believe it to be Piper. Anyway, this is the total capitalization weight of the high momentum stocks in the market and their weightings to the whole index. And you can see that when you get over 30% weighting in these high momentum stocks, that this is a very extreme level for them, and often coincides with a bull market peak. But you can see, look at this, 1929, and above 30, these high momentum stocks are above 30%. The Nifty 50 era, which we've talked a lot about here in the early 70s, because we think there's a lot of correlation between today and the early 70s, the late 60s, and from an inflation perspective. But the Nifty 50 era, and look at the dominance of those Nifty 50 stocks, one decision stocks of the 60s into the 70s, over 30% weighting. And then note here, COVID, and then an all-time high here from the megas. And so a pretty amazing area. So the megas are definitely way overdone here. And so
Bruce, I have a question for you about this chart. All-time high today. And as we look at those over 30 or close to 30, readings, they're usually going to be associated with some kind of theme. So Nifty 50, 2000 is the tech bust, COVID, obviously. And then would you agree that, like if something happens today, it's all going to be around the Fed, the inflation, the, that boom that we had of the COVID low with such an influx of liquidity? Would that be the name for it once it's all done?
Well, I don't think there's any question that the huge liquidity spike that we had from the COVID era, really drove these stocks to immense valuations. I mean, as a group, their valuations are just, unparalleled and very, very high. And then also we have, like, in the Nifty 50 era, that was, you could buy these Nifty 50 stocks, these one decision stocks, and hold them forever. And so those are such important companies as Polaroid, for instance, one decision stock that kind of lost its way in the 70s. And there's many others just like that. So, these things change over time. I'm not sure I'm answering your question, but I do believe that there typically is a mania that goes with that. And I think AI is such an example, as we see NVIDIA catching an immense bid and becoming such an important stock, really as a function of its AI capabilities in its graphics cards. And so the MAGA era, social media and so on, has just driven these stocks. And I mean, they're immense capacity to make money. Like, I mean, looking at Meta, and I mean, it just continues to its valuation is just incredible. And Google, you know, they're just coining money. So anyway, truly unique franchises that really have no competition.
Mm-hmm. All right, let's talk about the breadth of the market. Is what we're seeing, Bruce, in price and volume action, is it being confirmed by the breadth? And you've been, walking us through this type of charts for a long time. So there was definitely an anticipation behind some of the deterioration that we've seen in the previous weeks, in the last 4 weeks before this decline. So right now, I think the question for me is, do we see the confirmation of the same idea?
Yeah, such a good question, Ramon, because I think the internal momentum peak in the market was actually the end of December. And we're obsessed with quarter end behavior. And we just made this peak into and straddling the end of the first quarter. But we had the momentum peak in the market the end of December. And you can see there that it really shows up in the 10-day advanced decline oscillator. And it became very overbought at that time. Now, the indexes went higher after that for the entire next quarter. But look at the NASDAQ up volume, which is the middle panel there and circled. And you can see the immense overbought there. And then in the new high list, look at how the new highs achieved their peak level in mid-December, which is the bottom panel. And so since then, look at the NASDAQ advanced decline. It's continued to really just straddle the zero line throughout, which shows that the NASDAQ composite advanced decline oscillator, which is unweighted, not skewed by the megas, is that you can see that it has just gone sideways and now has, since the end of the first quarter, where it made a local high, it's now in a downward stride and it's below zero. So you're starting to see the internals of the NASDAQ composite deteriorating in a downward trend. And then you can also see that taking place in the stocks, the up volume, which is the blue line in the middle panel. You can see it's been making lower highs here really since February, and it is now in a downward stride. And then if you take the net number on the up-down volume, which is just taking those two lines and netting them against each other, it's below zero. And so it's also, I think, in a vulnerable position. And of course, the new high, new low is tilted towards the new low list now and is below zero. So the internals, the breadth characteristics of this market has, I think, been deteriorating throughout the entire first quarter of the year.
Bruce, I see a lot of sell-in right here, where we see some rise in the down volume over the up volume, and how the up volume is starting to deteriorate. And you don't have to have the increases of sell-in or substantial decreases in demand after initial selling has been done. As long as the price continues going down, it's going to hit some of the stop losses. That liquidity increase is going to force people to liquidate even more. And when we, both Bruce and I, we've been on the institutional side, being the hedge fund managers, we understand that the hedge fund manager or any money manager always looks at two things. It's the absolute return and relative return. So they don't want to underperform the market or underperform the peers, and therefore the profit taken, especially after this type of runs that are historically somewhat unique. We do have quite a few of them in the history of the stock market, but they don't come that like often. Let's say the last one that I remember of this quality, obviously off the COVID low. But that's the momentum thrust of the bottom. The more appropriate comparison, I would say 2016 after the US election and into 2017. So with that, you have to understand how to read this, and Bruce just gave us such a masterclass in the last 4 weeks, of reading the breadth deterioration.
Well, and we have been using tools like this here. Really, what the message in WMD, which is that the list is narrowing. So trade the market, trade it from the long side, hold your stocks that are showing leadership and acting well, but keeping in mind that the internals are deteriorating, and you want to keep your risk management tight and keep your stops tight and be defensive in your risk management characteristics, but continue to play from the long side, because divergences can occur for a substantial period of time before they weigh the market down into where the indexes start to go down in earnest. And so this is the art of it, is to be able to see that. And you'll notice, for instance, on the New York, look at the moving average there, the 20 and the 10. We're starting to break down there and make a new low in that little area, which on a trading basis, I think is really interesting. Looking at the top, the advanced decline 10-day oscillator, you can see same story, won't belabor but same story as what we saw on the NASDAQ comp, and you can see the momentum high at the end of the year, and now look what it's doing. It's going through the 0 line, which is the lowest it's been since really since mid-January, and it's in a downward stride. And so that automatically makes us very defensive. And then you can see that the market, you can see the down volume is starting to stride upwards and is in a rising basis. So if it keeps rising, that confirms the downward trend in prices. And then finally, I would just point out, you can see the net number on the up-down volume, which is in a downward stride. And but the bottom one, which is the new high, new low list, is pointing down. And also, I would just make this point. The new high list made a new high in March, which I think is super bullish for the long term. So even though we may have price weakness in here somewhere, the March new high and the new high list suggests that we're going to get higher prices later on. Might be a month or two, but the point is that this is evidence in my mind, Ramon, of rotation. This says that rotation is going, flow is going towards these more value-oriented stocks, which are in the New York Stock Exchange.
And I was about to show this on this chart. Look at the up volume here for NYSE, right? So when we look at NASDAQ, the chart before, what do we see in the same area? We see flattening of the upward volume. So they're not buying it here, even though the price is going up. It's just fewer issues on NASDAQ are pushing the price up. So where does the money go? Where is it? And by the way, we're seeing also as the down volume increases, that shows that the money is coming out of this theme, and then it goes where? Where does the money go? Because the money doesn't slip right here. And this whole decline here, Bruce, I'm thinking this is just market related, profit taking,
Sure.
and rotation or no rotation, all stocks are going to be influenced by the market's gravity, because it's just too important to any of the stocks. So with that, I'd be looking for some kind of crossover here between up and down volume in then something like this, some kind of recovery, but some testing or some even more significant reaction.
We've been saying that with the NASDAQ, the megas, the big stocks, that institutions aren't going to get out of them. They have to reallocate because they've appreciated so much that they have to reduce the percentage holding down, which is a very positive thing for them. They are never going to get out of those stocks, and they're going to continue to hold them in excess of a normal allocation, because this is how you compete with these indexes, is that you have to compete on a capitalization weighted basis, which is a curse for them. And so they're going to continue to own the megas, but they are lightening up. And just the act of them lightening up, when those stocks represent 30% or more of the market capitalization of the entire stock market, when they lighten those up a little bit, that's a huge amount of flow into these little companies, which are like used to be huge companies, 20, 40, 50, $100 billion market caps, and they're getting flow from these mega caps, which I think that Microsoft now is like a $2.8 trillion market cap. And if they just raise a little bit of cash away from that, Apple and Tesla and these other companies, it's going to flood these other stocks with cash flow, with flow. And so that's why I think that the New York is looking so much better than the NASDAQ, which I think is really good for the future, because it says this is a rotation game now. So.
Mm-hmm. All right, let's talk about the sentiment. So we often go to the fear and greed of the CNN business website. And here you have two looks. You have the timeline at the top, and you have today's reading of 55, which is in the middle of everything. But the most significant thing that we've been discussing for the last weeks is this trading range right here, where the sentiment was still relatively high during the last leg up. But Bruce, what I'm noticing here, as the sentiment was becoming more and more bullish off the October low, we did not have the same continuation of the optimism after that. And obviously that was reflected in the price action itself. It was going up, but it was choppy. And now we are breaking down. So obviously, as correction starts to unfold, the sentiment readings go down. And you told me today that your anticipation is that we might come back to the 20th or even lower.
Yeah, that would be a great thing, because we know that if pessimism is high, which would be down into the readings of, say, the 20s or even the teens, we know that means that the marketplace has raised cash, become defensive, and they now have the fuel to be able to propel prices higher in the future. Look at October. October was just a correction in an uptrend, and look at the pessimism that developed. And so in July, at the July peak, it had readings near 80, and that was just a swing trading top. And Ramon showed us the 3 legs down from July to October, into October, and look at the pessimism that developed in the low 20s. And so that was a huge tell about fuel being there, defensiveness being in place. And look at how quickly the psychology changed. And here you can see, look at where the peak in bullishness was. It was at the end of the year, which we talked about being the internal momentum peak for the market. And I think, Ramon, the reason that we didn't have higher sentiment in the first quarter, even though we got higher index values, is because people stopped making more money.
Mm-hmm.
You know, they looked at their portfolios and they said, well, yeah, I see the index is going up, but my portfolio stopped going up. And so I'm just not as optimistic as I was.
Mm-hmm.
And so I think that they're just basically reacting to their P&L.
A chain reaction where institutions are aggressively buying, a public becomes extremely optimistic, and institutional crowd is extremely optimistic. Institutions start to take profits. That creates the rotation. That rotation decreases the number of issues participating in the uptrend. With that, as you just said, let's say public or institutions that still in the same stocks that they had here are starting to feel the pressure of the prices not going up as much, as the index itself, and not all of the issues are going up. And with that, the sentiment starts to flat out, and they are starting to take the profits. So on the way up, we had a lot of those supply spikes with a lot of like big increase in spread to the downside recovery. So it kind of all makes sense in that sequence, of the logic that we just went through.
So this is a study, these two studies we look at from time to time. So interesting. This one on the left is the National Association of Individual Investment Managers, not individual, but investment managers. And this is a group of investment managers that do market timing. And they're an organization. They're actually pretty good at what they do. And I've spoken to that group before, and very impressive people. So only kudos to them. But as trend followers, they do tend to become most optimistic as the trend is terminating, and they become most pessimistic at the lows. And then they follow the trend in either direction. And so you can see that what I do is a 13-week moving average of that data, and each one of those bars, which is in green, is a week. And this data gets published weekly. And I want to point out that at the end of the quarter in March, where that dotted line is, I put that dotted line to delineate that this is where they become over 100% invested. They are literally over 100% long. And so that is a measure of optimism. You can see that they achieved that in July. At that July peak, they were over 100%. And that was that little yellow obelisk there. And then also note that in October of 21, at the bull market peak, that they had a number of weeks where they were over 100% at the top. And so, and earlier you can see that they were over 100% as the trend was unfolding. And so, they make money as the trend unfolds. The longer the trend, the better they do. And so, but they do tend to have sort of a culmination and of all of them being on one side of the boat at these extremes. And also, I just point out in 2022, in July, at where we were looking at the accumulation structure, that was one of the most pessimistic readings from this group in the history of the data that I've got available to look at. So they were very, very, very pessimistic at the 22 lows as we were building accumulation. So there's a good example of cash building up that's going to drive future prices higher as the accumulation structure completes. So there's an actual visual confirmation of that phenomenon. And then over here on the right, this is actually a group. They poll their members, and the data is really quite good. They're very conservative, and I have spoken to AAII for many, many years, and a great group of people. And they like to self-direct their investing, and just putting that yellow obelisk where they tend to be the most bullish. And look at I do a 13-week moving average and look at the level that we've just hit here in the first quarter, and it matches the level that we got to in 2021, actually mid-year. Now, this is a good point, because mid-year is when we had the internal momentum peak in 2021 in the bull market. And so they were most bullish at the momentum peak. Makes sense. And then you can see they had their most bullish momentum peak in 2020, right before the COVID decline. And then back in early 2018, at that peak, they were very bullish again. And that was the beginning of a big range bound condition that led to a big shakeout in late 2018. So anyway, Ramon, this is just, here we are again. They become very bullish, among the most bullish they get. And so again, another warning sign.
You know, the thought that came to me, Bruce, as you're going through this chart and you're describing, you know, like the methodology behind their readings, is that we should have our own, you know, some kind of like a Wyckoff thermometer, sentiment thermometer as to what we think is happening, because Wyckoff method is based on the idea of the contrarian signal, meaning that when the sentiment is the most bearish or one of the most bearish, and with the correct read of the tape or the chart, you could make the decisions that are going to be less riskier. Of course, in the human psyche, it's all reversed, because trading, just in general, an activity that is counter to the psychology of our survival, you know, preservation. And with that, it's understandable why the sentiment is going to be the lowest at the lowest price. I think Wyckoff methodology allows to reverse this type of mentality, and we would have a very interesting sentiment trading, Bruce.
Oh, it'd be very interesting. And I would just point out with the AII data, look at that 13-week data. That was among the lowest reading in 22 that there was data for. Look at the week-to-week data. Look how pessimistic they were. And that means that they are raising cash and becoming quite defensive, and that cash is going to get redeployed back into the market as the trend goes up. And that is what creates an accumulation structure. And then the stock goes into the very strong hands of the composite operator, very special institutional category of very, very smart operators. They accumulated those shares, and they're going to hold them tight throughout the next uptrend. And look at the defensiveness among the public. That's just such a great illustration of that whole concept.
All right, let's go to the decennial pattern. I think the key here, Bruce, as you always say, is just to understand what are the probabilities for the structure for the current year that we are in, and how does that translate into our Wyckoff structural understanding.
Yeah, this is an interesting chart. This is a very important chart for us to consider in light of the point and figure work we just looked at and so on. This is just scenario building, and there's many decennial patterns, 10-year cycles, that don't turn out like this, but they can be remarkably helpful. And I've been using these for over 30 years. And so I keep very close track of them. And I just would like to point out that, look at how, first of all, just to explain the decennial pattern for those of you that are not familiar with it, is that what 1897 to 2020, the data is all summed together for the indexes, and there's a pattern or a sum of these, which is then plotted, and it year by year by year. So all the 0 years are summed together, all the 1 years, the 2 years, and so on. And from that, we get a decennial pattern. And so this is a tendency for how the decade tends to unfold. And it's remarkable, again, how well this works. And what I'd like to point out by us putting up the accumulation schematic is that there really is a commonality between the classic accumulation schematic and the way that the early years of the decennial take place. The worst, literally 3 years of the market tend to be the 0, 1, and 2 years, with the low coming in the 2 year, and then from there an uptrend developing. And some of you are going, well, that sounds really familiar to me, because effectively that's what's happened in this decade, is that we're following very closely this. Now, the COVID did have an effect here. So the COVID was a very weak period, but then also we had the 2021 bull market peak, which came, remember how we said the internal momentum came in 2021 in the middle of the year? Well, look, we have the middle of the year is the peak in 2021, but that was the bull market peak. And there was a huge amount of liquidity infused into the markets at that time by the Fed. And the peak actually came in the indexes at the end of 21, or the end of the 1 year. And so it's a little bit different from how the decennial looks, but not a whole lot. And you can see that there's a decline into the middle of the 2 year. Well, where did we get our low in the bear market decline? The low came in the middle of the 2 year, and we started to build an accumulation structure. And in fact, we can see here that we have the evidence or the characteristic of that in the decennial. And so we've started to work our way into an uptrend. And here we are into the end of the 3rd year. In the 3rd year, we made new highs above the 2021 peak, as this shows. And we are in the 4th year. Look what we have. We have something that looks an awful lot like a backup. We had very strong upward trend from the end of the 3rd year into the early 4th year. That's exactly what we've had here into the end of March, end of the 1st quarter, and then we have softness. Now, this is the part we're going to be testing for, is we have a pullback into mid-year of the 4th year, which appears as though we could have that happen as we laid out today in our studies. And then another rally up, a pullback. Now, this is an election year, and so being an election year, it might very well be that we get a push. We don't come all the way back like we did, but we maybe just stall up here, because there's some other seasonality work that suggests that might happen. But look what happens as we get into the 4th quarter of the 4th year. We set up the condition for the very best part of the decade. And that is the 5th year, which happens to be a post-election year. Now, we have point and figure counts that take us to higher prices, and potentially higher than what we already looked at as we talked about. And so the 5th year could be an exceptionally good year. And of course, this is what Wyckoffians live for, is we live for trends. And after accumulation structures, we look for uptrends. After distribution structures, we look for downtrends or markdowns, and we participate in those markups and markdowns. That's where the money's made. And so now we have to be good tape readers and market watchers to determine whether it's possible for this to happen. We talked about a reaccumulation unfolding here from this point on into mid-year. Well, that's exactly what this looks like in the 4th year of the decennial. It looks like a reaccumulation structure. So anyway, Ramon, your thoughts?
Well, yeah, I really like the setup. The analogs work until they don't. And as Bruce described it, since 2021 into 2022 low, 2023, and then the way how 24 is starting to unfold, it follows the pattern. So let's follow the pattern until it's broken. So
And of
my,
course, we're gonna be tape readers. We're gonna be
yeah.
Wyckoff tape readers,
Mhm.
and we're gonna let the tape tell us where it wants to go. We're not gonna use patterns, and we're not gonna use, seasonality and other things. We're gonna use those to help us to do scenario building. But we're always gonna defer to the market telling us where it wants to go.
Yeah, our edge is most definitely in the way how we read the chart relative to the historical analogs. So like, for instance, Kurt was saying, like, think about, 2008, 2012 outliers for the decennial pattern. So that's how probabilities work. Like if there is a probability of like 90% of this pattern happening and only 10% of the time it's not going to happen, there are occasions when that 10% would work out, right? So, and then we would have to think in a different way.
And I want to just go back for a sec. I just want to maybe, please forgive me for making the case that we'd love to have you join us in WMD, become part of our community, even for a short period of time, with this special offer that we've given you, or that we're putting forth, is that we think that this is a remarkably important year, and that if this unfolds throughout the course of the next quarter into the second half of the year, that it's going to set up, and this is going to happen because we're getting a massive rotation into other areas of the market. And I think, have a golden opportunity to set ourselves up potentially for a very important markup phase. Now, it may not happen. We may get distribution, but we'll be able to see it through the course of the year. But join us for a couple of months. Sign up, take advantage of the special rate being offered, and join us. I think we can add tremendously to the value, to your value and to your tactics in terms of how you set yourself up to take advantage of the future. And we are going to be looking for rotation, where the strength is going, where the strength is leaving, and when the opportunity, the junctures for taking advantage of these important opportunities. And so just, spend some time with us and learn more about the Wyckoffian approach, because Wyckoff is a method. It's not just a series of indicators. It's a cohesive methodology that's designed to create results in the markets consistently, year after year, cycle after cycle. So that's all I'm going to say. But I really do think that this is going to be a critical time to be a superb tactician and be able to really set up for these opportunities that could develop. Because if it's a reaccumulation, and this is what we're looking at in the 50 year, it's going to be a great opportunity. If it's distribution, it's probably going to be distribution that leads to an important decline. And we're going to want to be defensive and take advantage of that also. And so this year is going to be, I think, a very critical year. So anyway, that's all I'll say, Ramon.
Let's talk about the yearly seasonality. It's not going exactly how we were thinking about it, right, at the beginning of the year. Although I think, Bruce, the way how the market was going up, like with this type of move, where there is a new high and then we always would come down. And now we're going, well, the March was like this as well. That to me was more of the reflection of the strength of what was on the background. in the background. And with that, that's the variation on the seasonality. You have to adjust the seasonal projection to the strength of the trend. And I think, Bruce, that's what has happened.
Well, and also keep in mind, this is an election year. In election year, there is lots of motivation by really all politicos to make sure the economy is clicking, things are going well, and so there's lots of spending going on, lots of liquidity being pumped in the system. I think the Fed even has been accommodative in ways that is very subtle because of they're wanting to maintain these financial markets and keep them running smoothly, especially in light of recent banking troubles. But this is the point I would make in the seasonality chart, is that we have into May, possibly into June, we have a sideways or a flat market environment. And then look at what we get. We get a two-stage advance into the end of the year. And that is somewhat consistent with our decennial pattern. And so it could be that sometime in the second quarter, we're going to start to see a good setup for a more important uptrend developing or emerging into the second half of the year, into election time. And maybe we get weakness into October, into the end of the third quarter, and then strength into the end of the year. Classic election year kind of behavior. But this could be the essential emergence of a more important advance that could be coming if those point figure counts, the higher ones, can be attained.
Okay.
I'd move on. The only thing I'd say about this is the yield curve, and this is through April 5th, but just pointing out that the yield curve is still negative, continues to be negative. We're in a tight money timing zone. And so this, and today we had a very, very ugly bond market. And so the bond market, I actually think that the bond market, because of the epic bear market in bonds that we've had in the last few years, has actually been a source of capital to the stock market. And I think that people are abandoning bonds, and it showed up today in the auction. The auction was very sloppy, one of the worst. And I think, Ramon, that this is a source of capital for stocks. And I think that there's a number of really good companies out there that have good yields, grow their dividends year in and year out, and have good valuations. And people are looking at those and going, this is a better deal than owning bonds.
Mm-hmm. And look, Bruce, what's happening on the opposite side of this, right? So the 10-year today had the best up.
This is yields. This is yields.
Yeah, yields. Yeah.
Yeah.
The yields had the best move since the lows here at the beginning of the year. And we've been pointing out how the behavior has changed here, how there are a lot of impulsive spreads that are suggesting higher prices. And even though our projection for the first half of the year was to remain in the lower part of this much larger structure, that was our call. But it's amazing how Fed influences those type of the decisions, right? And how it changes the sentiment. We've talked about this area right here, where there was an expectation for the QE to start, and then Fed said, no, we're going to have more rate hikes. And then how does this materializes into an uptrend? So here, the same thing. Here is an area where there are expectations for the QE. And then the Fed comes out and says, yeah, maybe there will be in the future, but for now, we are actually still trying to see the inflation numbers. And for now, we are staying put. And maybe even we'll have a rate hike or two. And that changes the behavior here. So this area right here, to me, is somewhat similar to this in the way how behavior of the price action starts to change and you start seeing impulses to the upside. So with that, Bruce, I'm thinking, is there a possibility for the yields and for the 10-year here specifically to actually come back to the all-time high here?
Well, and the inflation numbers are supporting that too. The CPI data today, was disappointing, and
Yes.
And PPI is likely to be disappointing tomorrow.
And look what dollar is doing. It's following the same thing. So bonds are down, yields are up, dollar is up, gold is up.
And yeah, so let's conclude with just showing them a couple of gold charts, which is number 22. Yeah, this is a study that we did. We've been talking about this for not every time, but we've been resurrecting this chart from time to time, going back almost 400 episodes at WMD. And but I wrote a blog in August of 18, and you can see it. I wrote it when it went down to that support zone in 2018, which was the selling climax low from 2013. Look at the size of this structure. Oh my gosh, this thing, and these are monthly bars. Now, that was a great time to write that blog, because then look at the move that occurred thereafter, and it rallied up to the buying climax peak of 2011, and then went into a backing up type action, which also was a reaccumulation. And that backing up action had a very tight range, but it was pure torture for gold traders. And now look what it's done. Now this chart is only through April 5th, and it's gone higher since then. And so you can see that it very clearly is breaking away, and the upward stride of this is very noticeable. It's very dominant. And so this, I think, is also, this is happening at the same time that the dollar is strong, Ramon, and which is kind of unusual. Usually gold goes up when the dollar's weak and vice versa. And here, look, they're going up together. And so that means that gold's going up in other currencies even faster. So I would look at this and say, this is just the beginning of a very important advance that gold could have after completing this substantial structure that goes back more than a decade. So, and then if we look, if we want to look at more recent data, we can just look at the next slide, and maybe this is where we'll conclude. But these two charts on the right, you'll notice that all I've done is taken this area in 2023, which is only a part of that reaccumulation structure that goes back, like to 2021 or something. And so that count, and this is an example of a accumulation count and a reaccumulation count confirming each other, and then a markup beginning, as I had mentioned earlier. This count takes us up to 2400 to 2510. And the reaccumulation count goes 2380, 2460. And so we are now in the throes of fulfilling the minimum count objective for this area, which is only a tiny portion of that whole structure we just looked at on the monthly. And then underneath, if we take the area back to 2021, which is the reaccumulation structure, not the bigger accumulation structure underneath it, that area there, and again, many of you are looking at this and going, well, you can count that even bigger. And you're right, you're absolutely right about that. But I took the conservative count, and for a number of reasons, I think this is the proper conservative count, 3,500 to 3,700. And people would say, no, it can't do it. It can't get there. Just as they said that about the accumulation for the S&P 500 back in 22, in 23, and here, and this is just a teeny tiny part of the whole structure. So this is potentially a monster, and the whole materials segment of the stock market has come to life and has become very important leadership. And there's tremendous value attributes to many of the commodities out there being traded, and many of those are being are part of these materials companies. And so and we are going to spend a lot of time going through and looking for leadership in that area, which we've already done some of. And then this chart on the left is just a vertical that just basically goes back into last year, 2023, and look how beautiful that structure is. And then beautiful backup, and now just a very stiff markup out of that area. Ramon.
Well, I think the biggest question, as you've said, Bruce, it's the movement of gold together with the US dollar. So the answer to that, I believe, will come later on. We will understand this answer later on, although there are some, thoughts that will probably develop in the next sessions of why this happens. The character of the move absolutely suggests higher prices, even if we're going to have some kind of testing period. And you could look into this idea from the perspective of the selection as well. You could look at silver, you could look at miners on both sides, and pick something from a basket of ideas rather than just gold. But the way how gold has traded lately, and I've seen a lot of trades lately in gold, it just moves, and it's a very easy market to trade right now, and was easy market to trade. But we're definitely going to have some kind of stop in action, testing, corrections, and again, here we will be looking to interpret all of those price actions. Bruce, is there anything else? I know that we are already
I
beyond
think
the
that
time.
was a really good
Mm-hmm.
good place to stop. And
okay. Right.
But up to you, Ramon. You may have other.
Why don't we make a preview of what maybe we will be discussing next time, right? So we're following all of the assets, major assets. So with this, this is the look at oil. We've been commenting a lot on the upward bias since the beginning of 2024. We're going to look at that. We're going to look at the oil services. We're going to talk about Bitcoin and what should happen here, or what we think might happen here. And then usually there was a question, do we look at stocks? Do we look at the sectors? Do we look at the industry groups? Absolutely. And usually these sessions are divided into two parts. We in an open door spend a lot of time talking about the market, but during the regular sessions we definitely spend a lot of time talking about specific stocks. We show you the top-down approach. We show you how to work with your watch list, how to work with the watch list from websites like stockcharts.com, and it's a lot of fun. We have other activities during these sessions that I don't have to mention at this point. For those of you who are a part of our class, go ahead, guys, to the website, sign in, and vote as we usually do each week. And just want to invite our guest of today to join us. I see a lot of you already expressed the desire to join us. We use the promotion, and that's going to last until next session, until next Wednesday. And we're looking forward to working with you, Chris.
So they just go to the WMD page in Wyckoff Analytics, and when they go to sign up, it'll have that promotional price. I'm asking, just to clarify.
I'm sorry, Bruce, I was distracted. What are you asking?
Oh, just they'll see the promotional price if they go into the WMD page and then go in to sign up for the service.
Yes, absolutely. So on the live education, weekly Wyckoff market discussion, and Nancy changed the price to $79. So this price will be there until next Wednesday. You could also sign up for the quarterly. And again, looking forward to working with you guys.
And somebody asked about the recording. And so there will be a recording of today.
Yes.
And for people that came in late or
absolutely. We will post the recording tonight to our YouTube channel. It's Wyckoff Trading Method. It will be our featured video, and then we're gonna put it under all of the Wyckoff educational courses. And you could see different examples, you know, from the past sessions that we have. You could kind of like see the material that we create on the weekly basis. Go check it out. You know, we've been around for years and years, so there is a lot of free material that you could explore. There is a lot of material on our website. There is a lot of material, even more material in the classes themselves. So absolutely would recommend you to explore all of this.
Thank you all for being here. And what great session, Ramon. And I just really appreciate all the great feedback I've gotten from power charting. Now, for our power charting fans, you know, this is a great place to continue that tradition. Is here, and I think it's even better. It's more in depth. It's a lot of fun. We have a great time every week doing this.
All right. With that, thank you guys so much, and we'll see you next week. Thank you, Bruce.
Take care, everyone.
Bye-bye.